Okay, this week in the mortgage world, the Federal Reserve's decision was really the headline act, and the markets were ready for potential adjustments to those rate cut expectations, and we were thinking the Fed might only plan for 2 cuts this year following this, but surprisingly, in a good way, the Fed looks like it's going to stick to those 3 rate cuts, and the Fed's decision to leave policy rates unchanged was pretty much expected, so seeing that 3 cuts this year is still pretty likely was a big pick-me-up. Now, moving forward, all eyes are going to be on employment numbers and inflation trends. Most recent inflation data has come in mixed, which has kind of been the norm lately. We got CPI report hinting at a continuing slowly downward trend in inflation, but it didn't come down as much as we hoped. But in wholesale inflation, that's PPI, it came in hotter than expected, which kind of adds to the anxiety that inflation's not cooling as quickly as we need it to. But NAHB Housing Market Index, housing starts and permits offered a bit of positive news, indicating a resilient housing market, and we are seeing various economic indicators suggesting potential stress on consumers on the other hand. But as we close the week, the Fed's more dovish than expected stance has given us a glimmer of hope for mortgage rates, but new labor and inflation data can change that, and that'll guide the Fed's stance on rate cuts. But stay tuned. Next week, I'll have an update on appreciation, home sales, and the Fed's favorite measure of inflation, PCE. Have a great weekend.